Welcome to The Explainer. Today, we're going to tackle a huge problem, something that trips up so many investors. You might be fantastic at picking individual stocks that are winners, but is your portfolio as a whole actually winning? We're going to move past just collecting companies and learn how to build a truly powerful investment portfolio, the way the pros do it. Okay, let's jump right in.
It's maybe the most frustrating question in all of investing, isn't it? You do all the homework, you find a great company, you invest your hard-earned money, and then, at the end of the year, you look at your returns and you're lagging behind a basic market index. Why? How does that even happen? Well, the answer is probably not what you think, and believe it or not, it has very little to do with which stocks you're actually picking.
This quote really gets right to the heart of the whole issue. Just think about that for a second. Stamp collecting is about finding individual pretty things you like. It can be kind of random, It's often driven by whatever catches your eye. But building a machine? Whoa, that's a whole different ballgame. That's a systematic, purposeful process where every single part has a job to do, and they all have to work together perfectly. That's the huge mindset shift we're talking about today. All right, so first things first, let's diagnose the problem. We're going to call this the stock picker's trap. It's that super common but deeply flawed approach that feels like the right thing to do, but almost always leads to a portfolio that's shaky, unbalanced, and in the end, just doesn't perform. Does this process sound a little familiar? You find a company you're really excited about, you invest whatever cash you have on hand. Then you find another one, and you do the exact same thing. This way of thinking treats every stock like it's on its own little island. There's no master plan, no structure, nothing connecting the dots. And that is precisely why it so often falls flat. Okay, so now let's completely flip the script. The pros, they operate on a totally different principle. There's a secret, if you want to call it that, which governs nearly all of their success. And it's something that most of us regular investors spend almost zero time thinking about. It's time to pull back the curtain on what really, truly matters. I really want you to take a second and think about this. What is it? Is it finding the next huge tech company before anyone else does? Is it your genius-level ability to read a balance sheet? Look, those skills are definitely helpful. But the single biggest driver of your returns, it's something much, much more fundamental. And here it is. This number is just staggering. Somewhere between 80 and 90% of your portfolio's long-term performance comes from your asset allocation. Let me say that again. It's not which stocks you buy, but how you decide to spread your money across different categories in the first place. Your amazing stock picking skills, they only account for about 10, maybe 20% of the final result. The big takeaway here is that we're all focusing on the wrong thing. We need to be obsessed with the 90%. Okay, so if asset allocation is the key, how do we actually do it right? Well, we build a machine. And just like any well-engineered machine, ours is going to be built on a really clear blueprint. So let's walk through the 4 absolutely critical pillars for putting together a solid, high-performing portfolio. Here is how that machine gets built. It stands on 4 strong pillars. First up, asset allocation. This is your big picture decision. You decide your split between, say, stocks and bonds before you even think about a single company name. Second, sector limits. You've got to set hard rules, like capping any one industry at 20% of your portfolio, so you're not putting all your eggs in one basket. Third, position sizing. This one is so important. You have to limit any single stock to just 5 to 8% of your total portfolio. That way, no one company can ever blow you up. And finally, Pillar 4, rebalancing. This is the engine of the machine. It forces you to systematically sell what's gone up and buy what's gone down. It's all about disciplined, rule-based investing. The difference in approach is really just night and day. When you see the 2 ways of thinking laid out side by side, it's pretty stark. This contrast reveals everything. The amateur's starting point is chasing a hot stock. The professional's starting point is setting an allocation target. Amateurs just throw random amounts of money at things. Pros use strict, risk-adjusted position sizing. Amateurs rebalance based on fear or greed, if they do it at all. Pros do it based on preset, automatic triggers. And the result of all this? The success rates aren't even in the same league.
The professional systematic approach is literally built to win over time. So we've seen the theory, we've seen the proof. Now let's boil all this down into a practical playbook, something you can take away and use to start building your own portfolio machine, like right away. Here it is, your cheat sheet. These are the new rules to live by. Number 1, set your targets first. Number 2, enforce those strict limits on any single stock or any single sector. Number 3, rebalance methodically whenever things drift a little too far. And this last point, this might be the most important one on the whole list. Successful investors flip the script. They spend 90% of their time and effort on this framework, and only 10% picking the individual stocks that fit inside it. And in the end, it all just comes down to this one idea. This isn't just a change in your strategy, it's a fundamental shift in your identity as an investor. You are not just a collector of interesting companies anymore. You are the architect of a wealth-building machine where every single piece is chosen specifically to serve the whole. So I'll leave you with this one last question. Now that you know the difference, which one are you going to choose to be? Will you keep collecting stamps, just hoping for the best? Or are you going to pick up the blueprints and start building your financial future, like an architect? The choice is yours.